Anybody have any questions on homework number 3? Right, that I sent that to you yesterday. It's due on Monday. Anybody have a chance to look at it? Have any questions, comments, etc.? So,
Sorry, I do have a question.
yeah, jump in.
For number one, s- sometimes it gives increases or decreases by an actual value. Do you want us to pair that with an actual answer with the value of inflation? Or do you just want to tell us what happens to inflation?
You should.
Like an increase.
Yeah. So here you should be able to say exactly what happens to inflation, right? So if the money supply doubles, meaning it goes up by 100%, you should be able to say exactly what happens to inflation, right? So give a concrete number here.
Thank you.
Mm-hmm. For question number 2, I just realized in your book, it only has, like, for instance, Babe Ruth's salary in 1932. This table only has CPI data from 1930 or 1940. So just use 1930 CPI. It doesn't give you the exact CPI in 1932, but that's close enough, right? Same for 1945. I can't remember. Just use the data that's as close to the date as possible, okay?
So, I also had a question too.
Yeah, sure, Carson.
For number 2, they don't have the 2015, but they do have 2018 CPI. So do you want us to use that?
Just use 2018. Yeah, use whatever's close. Yeah, actually, you're right. That should be 20. Wait, isn't the base? I'm trying to look at forget the table. Is the table's in 2015 your prices, or is it 2018?
It's 2018 base CPI.
Yeah, sorry about that. Yeah, so you just use 2018 as the base here. Cool. Any other questions about homework number 3? So, at the risk of being a real asshole, I'm going to send you homework number 4 this afternoon as well. Right? So, homework number 3, the one I sent you yesterday, is on what we talked about on basically Tuesday and Thursday. Okay? So, and that one is due on Monday. Homework number 4 is going to be due on Wednesday, and it's going to cover what we talk about today and on Monday. So I'm going to send you homework number 4, even though it's not due till Wednesday, so that you can do the material from today's lecture over the weekend if you want, right? So I'm really not trying to be a jerk. I'm just trying to give you stuff as early as you can, so that when you have some of you might have a little bit more open time over the weekend, that you can actually get a head start on homework number 4, because these next 2 homeworks, given where the exam is, are going to kind of come close together, right? So homework number 3 is going to be due on Monday. Homework 4 is going to be due on Wednesday. So, try to push them together here a little bit. And so I want to make sure that you have enough time to work on them, so that nobody finds themselves, kind of stressed, or, well, unnecessarily stressed or behind the 8 ball. So anyway, so do be looking for that, and if you have time this weekend, you can not only finish up homework number 3, but you can get a head start on homework number 4. If you have questions on homework number 3, I think for the most part, homework number 3 is maybe a little bit easier, because there's not any super long technical questions, but feel free to send me an email and we can talk, or we can have a little Zoom session or whatever. My weekend is probably a little bit more open than last weekend. So anyway, I'll be around to help with questions if you have any. Okay. All right. So if there's no other questions about homework number 3, then let's jump into what we're going to talk about today. So today we want to talk about monetary policy and interest rates and inflation, right? Yesterday, we began to develop this short run macro model. And so we talked about the relationship between interest rates and short run output. And we talked about how we conceptualize short run output in our macro model. And we developed the IS curve, right? Which is basically, sorry, turn the slide on. So we developed the IS curve, which is basically a way of relating how real interest rates impact short run output. Hold on one second. Somebody is texting me. Can you guys hear me okay? Okay. Who's Olivia? Olivia's texting me. We don't have an Olivia in this class. I'm not sure what's going on here. Anyway, so yesterday we talked about the IS curve, which relates how real interest rates impact short run output. And we kind of developed some of those cornerstones of the model. So today we want to begin to talk about, well, where do real interest rates come from? And like I said, that really means that we have to talk about inflation and we have to talk about monetary policy. Okay, so let's begin here. Okay, so chapter 12. Right, monetary policy, interest rates, and inflation. So in chapter 11, when talking about the IS curve, we ignored a couple of important things. First off, we ignored how interest rates are determined. We also ignored inflation. And as we've talked about earlier in the week, inflation and interest rates are closely related to each other. And we also said nothing about monetary policy. Because also, as we talked about earlier in the week, you can't talk about inflation without talking about monetary policy, right? Inflation is a monetary phenomenon, as we talked about. And so this is really the purpose of chapter 12, is to try to make our model a little bit more realistic here by beginning to talk about interest rates and inflation and monetary policy. And so this is going to lead us to creating what's called the MP curve. MP, short for monetary policy. Which is the relationship between monetary policy and interest rates. Monetary policy impacts interest rates. Okay, monetary policy impacts interest rates. So we are going to assume here, make a couple of assumptions to kind of simplify our analysis of how monetary policy impacts interest rates. First off, we're going to assume there's only one interest rate. We're going to assume there's only one interest rate. Is this a good assumption? Well, not really, right? We know in the real world, there's many interest rates. You know that you get a different interest rate depending upon who you are. You get a different interest rate depending upon how long you borrow money. You get a different interest rate depending upon how you want to use that money. You get a different interest rate depending upon whether you're borrowing through a stock or through a bank, right? So in a real world, there's thousands of different kinds of interest rates. We're going to keep things simple, though, and just assume that there's only one interest rate. And this is probably a good assumption because interest rates do tend to move together. So while there are thousands of interest rates within an economy, they also tend to be fairly closely related to each other. And so talking about an aggregate interest rate is not a horrible abstraction from the real world, quite honestly. Now, here's a second assumption. This one's a little bit trickier, and we're going to have to talk about this one. We're going to come back and talk about this one a little bit later as to how we can justify this. But we are going to assume that inflation is sticky. What does sticky inflation mean? We're going to assume that prices are slow to adjust. We're going to assume that prices are slow to adjust to new information. And at the end of class, or toward the end of class, I'm going to come back and talk about how do we justify this? How is it that we can argue that inflation and expected inflation are slow to adjust? And so we'll talk about reasons why some economists believe that that prices are slow to adjust. And there actually are very good reasons to believe that some prices in our economy are slow to adjust. Why is this such an important assumption? Well, the implication of these two things is that a central bank changes the real interest rate when they change the nominal interest rate. Okay, so the implication here is that the central bank changes the real interest rate when they change the nominal interest rate. So as we've talked about before, right? Here's what we call the Fisher equation. Right, we talked about this on Tuesday. Here's the nominal interest rate. Here's the real interest rate. And here's expected inflation. But what happens if this is fixed, if it's slow to adjust? In that case, if the central bank increases the nominal interest rate, it also increases the real interest rate. And so by assuming that expected and actual inflation are sticky, we're saying that the central bank controls both the real interest rate and the nominal interest rate. When the central bank changes the nominal interest rate, it also changes the real interest rate. So under these two assumptions then, we can talk about an MP curve. And adding that to our model. So here is the IS curve that we developed yesterday. Okay, here's the IS curve that we developed yesterday. Now to this, we can add that the central bank sets the real interest rate. And wherever they set the real interest rate is where the MP curve is. So the MP curve is just a straight line set at wherever the central bank sets the real interest rate. So the central bank sets the real interest rate. The central bank sets the real interest rate. Notice here, though, that a change in the MP curve will change the real interest rate and move us along the IS curve. Okay? So, actually, let me just redraw this graph if I can. Draw a little bit bigger. What happens if the Fed reduces the real interest rate? In this case, now the real interest rate falls below the marginal product of capital. And what happens to output? Short run output goes up. So the Fed can stimulate short run output by cutting interest rates. Right? So the Fed controls the real interest rate because inflation and expected inflation are sticky. So by lowering the nominal interest rate, they lower the real interest rate and they can stimulate output because that moves us along our IS curve. What happens in the opposite case? I'm going to do this in green. This is going to be a complicated graph here. But what happens if the Fed increases interest rates? In that case, it shifts our MP curve up so that the real interest rate is greater than the marginal product of capital. And what happens to short run output? Short run output is less than zero, right? So the Fed now has the power to slow the economy down in the short run or speed it up in the short run by changing the real interest rate relative to the marginal product of capital. So the MP curve captures the Fed's ability to set monetary policy, and by setting monetary policy, then influencing short-run output. Okay. So let's work through a couple of examples here. Just to make sure that we understand this. Okay, so example number one. Let's think about how should the central bank respond to a negative aggregate demand shock. which in our model would be A bar less than 0. So A bar falls, little a bar falls, and aggregate demand falls. How should the central bank respond to that? Right? How should they respond to that? Okay, first part of this is what happens if little a falls? Well, that's a negative aggregate demand shock. As we talked about yesterday, that should reduce our IS curve and short run output falls. Okay. So the IS curve goes down because little a bar falls. Short run output falls, and we go into a recession. Now, the question is, what should be the central bank's response? Well, here's a case where the central bank would want to stimulate the economy, right? If short run output has fallen, the central bank would like to get us back to trend. How do they get us back to trend? They reduce real interest rates below the marginal product of capital and shift down the MP curve. Notice here, this can often feel backward, right? To stimulate the economy, the central bank shifts the MP curve down, right? By lowering interest rates. And if they do this right, they drive short run output back to 0. Okay? It's so simple. in this model, it's so simple to be the Federal Reserve, right? Whenever the economy slows down, you just cut interest rates. And when the economy speeds up, we'll talk about that example here in a minute, but you can guess you raise interest rates, right? You raise interest rates. So this is what stabilization policy is, right? Stabilization is trying to stabilize the economy around trend, around its long run level of output, so that we don't have these fluctuations in output either being too low or too high. So, once again, what the Federal Reserve is looking for is it's looking for a Goldilocks economy, right? We don't want things too hot or too cold. Here, the economy is too cold. We're having a recession. What should the Federal Reserve be doing, or what should the central bank be doing? Trying to heat things up. What happens just in the opposite case very quickly? What happens if there's a positive aggregate demand shock? So here, bias curve goes up, short run output goes up. What should be the Fed's response or the central bank's response? Here the central bank wants to raise interest rates. so that short run output gets driven back to 0. I didn't really draw this very well. Sorry. Let me try this again. They want to drive it all the way back to here. There we go. So that short run output goes all the way back to 0. So the Goldilocks economy, right? Not too fast, not too slow. Now, hopefully that makes a fair amount of sense, right? That's not too complicated addition to our model. However, you might have asked yourself here, particularly when we talk about this example, why does the central bank worry about output being too high? Is that even a worry? Why should we care if output is high? Isn't that all good? Why doesn't the central bank allow output to just keep on going up and up and up? Why should this central bank be hitting the brakes when the economy is growing fast and people are seeing their incomes go up? Well, the reason why this is because this analysis doesn't think about one of the complications of output growth being too high, and that's inflation. And so we need to add inflation into our model if we want to have a more nuanced view about what's going on. And so the other part of our model that we want to add today is we want to add inflation. And we're going to do that through an idea that we talked about yesterday, the Phillips curve. Right, so the Phillips curve is the way that we add inflation to our model. And let's talk about the intuition about the Phillips curve before we actually derive the Phillips curve. The intuition here is that firms are subject to capacity constraints. Firms are subject to capacity constraints. What happens when short run output becomes positive, that we start growing faster than trend? We begin to experience shortages. We begin to produce more than we can sustain based on our productivity levels and inputs. And so these shortages at full capacity put upward pressure on prices. And that leads to higher inflation. So in other words, the reason, the consequence of short run output being greater than 0 is that's going to put upward pressure on inflation. Why? Because of capacity constraints. Now firms are faced with shortages of capacity. They're faced with shortages of workers. What are they going to have to do? They're going to have to start paying more for inputs. And as they begin to pay more for inputs, they're going to begin to increase prices. Right? It's really just the opposite when a firm is in a recession, when short run output is less than 0. When short run output is less than 0, then what we have is we have excess supply. And when you have excess supply, how do firms get rid of the excess supply? They cut prices. So the idea behind capacity constraints is that when short run output is positive, it tends to put upward pressure on inflation. And when short run output is negative, it tends to put downward pressure on inflation. And this is really just simple supply and demand stuff, right? I mean, this is, I think that the microeconomic intuition here is pretty simple. When firms have excess supply, what do they want to do? They probably want to cut prices and sell more. What happens when they're at full capacity? They can't produce more, or it's hard for them to produce more, so they begin to raise prices, right? And so that intuition is pretty consistent with a lot of, I'll say, micro theory of how firms operate, right? In reality, capacity constraints are a very important part of firms' pricing decisions. And that's essentially what this Phillips curve argument is making, right? Is that capacity constraints mean that when short run output is high, inflation is going to get pushed upwards. And when short run output is low, inflation is going to tend to be dampened down. How do we capture it? Well, we can capture this idea in a pretty simple equation. This is our Phillips curve, what we'll call the Phillips curve. And the Phillips curve simply says that actual inflation is equal to expected inflation plus V bar times short run output. Okay? What's this? You can think about V bar times short run output as demand conditions. Do we have excess demand? If so, then this is greater than 0. And if we have excess supply, this is less than 0. What is V here? Well, V obviously is exogenous, and you can kind of think about this as a measure of how tight capacity constraints are. So if capacity constraints are really tight, then V is going to be higher. And inflation will change more with short run output. So once again, V is exogenous, and it's just kind of a measure of how tight those capacity constraints are. The tighter they are, the more that inflation is going to respond to a change in short run output. The looser they are, meaning if capacity constraints don't really kick in very quickly, then V is going to be smaller, meaning that a change in short run output is going to have less impact. Now, here's one other thing we have to talk about here, though. How do we set the expected inflation rate, right? Notice that the expected inflation rate is in here. And we're saying actual inflation is based on expected inflation plus demand conditions. But we've never talked about how do we set expected inflation? How do we set expected inflation up here? We have to make some assumption about this. Well, let's make an initial assumption. And this is a simple one, okay? And this would be what we would call adaptive expectations. An adaptive expectation simply says the past is the best predictor of the future. In other words, what should be expected inflation this period? It should just be actual inflation last period. Is this a good idea or a good assumption about how people make expectations of the future? Well, this is also something we're going to want to talk about some more as we go along. First off, I always have to think about adaptive expectations every time, we're on campus about this time of the year. And when you have a day like yesterday that was very warm, and then you have a day like today, which is much colder, and I look out there on the Ped Mall, and what do I see? A bunch of college students walking around in shorts and t-shirts, freezing their butts off, right? Because what have they done? They've assumed that what's the best predictor of today's weather? Yesterday's weather, right? So yes, oftentimes people do use adaptive expectations. However, this also really assumes that people are pretty dumb, right? I mean, that people don't ever look forward and try to predict what's going to be true in the future, right? I mean, you can think about it, adaptive expectations in some ways as like driving a car by looking out the back window. That works okay as long as the road is straight, but if there's any curves in the road, you are not going to be happy with the result. And that, of course, is part of the problem here, is that by assuming adaptive expectations, we're really assuming that people are pretty dumb, that they don't see things coming. And so we want to talk about this more as we go along. But as I said, at least initially, let's make this very simple assumption that people just look to the past when thinking about forming expectations of the future. So if that's how they form expectations, then what happens to our Phillips curve? It becomes this. Or this. And this is how we are going to write our Phillips curve typically. This is the typical form of the Phillips curve that we are going to use. So if you think about this graphically, on the horizontal axis, we have short run output. On the vertical axis, we have the change in inflation. And notice here that we have a vertical line, the slope of which is equal to V, right? How tight those capacity constraints are, how tight those capacity constraints are. What should be true in the long run? In the long run, short run output needs to be zero, which implies that the change in inflation is also zero, meaning inflation is steady. But what happens if we're up here on this point? The economy is booming, but so is inflation. And what's happening down here at this point? The economy is in a recession and inflation is falling. That's what our Phillips curve is capturing. That short run changes in output directly relate to changes in inflation. And let me just emphasize this, hopefully this is clear. But the key here is changes in inflation, right? It's not changing the inflation level, it's leading to the change in inflation. Does that make sense? So when we say, for instance, the change in inflation is 1%, we're saying that inflation is going up by 1%, right? So it doesn't say anything about the level of inflation, it's saying what's the change in inflation. So short run output will lead to consistent changes in inflation. If the change in inflation is constant, the level of inflation is going to keep on rising. So if you stayed up here, let's say you're at this point, right? This point where short run output is positive. What happens if this was consistent with, let's say, a 1% change in inflation? What does that mean? If you were at inflation 3% this year, you'd go up to 4% next year. And if you stayed there another year, you go up to 5%. Then you go up to 6%, then 7%, then 8%, right? So in other words, inflation would be rising over time. So not the price level rising, but the inflation rate would be rising here. Okay, I want to talk about one last thing here, and then we're going to take a break. There's one last complication. Right, one last thing that I think we should add to our Phillips curve, and that is a supply shock. Exogenous supply shock. This allows for the possibility of cost push inflation. And what I mean by that is something big happens to the cost of inputs. Or some sort of disaster. Like COVID, right? Or some natural disaster. For instance, just to kind of pick an example from something that me and you and all members of the Cornell community have been dealt with. You know, one of the things the college is really struggling with is how do we pay for the cost of COVID? So you know, it sucks, and I know all of us are not happy about teaching online. But the fact of the matter is this has been very costly for the college, right? I think the college has ended up spending about $1,000 a student to cover costs associated with COVID. And what are these costs? They're cleaning costs, there are testing costs, there's costs in terms of separating people more, there's costs about, you know, dealing with food service because we can't do it in the same ways. I mean, all these little costs have been extremely expensive, right? Extremely expensive. And so these are the kind of shocks that we should probably include in our model, right? Allow for the possibility that sometimes there are supply shocks that could occur. And so we're going to call these supply shocks O bar, and we're going to make them exogenous, right? So we're not going to explain where they come from, but we can add this to our Phillips curve. in just the simplest way. Okay? Just add an exogenous supply shock. Where here, if O bar is greater than 0, that's a negative supply shock. Why negative? Because it's pushing up inflation. And O bar less than 0 would be a positive supply shock because it's driving down inflation. But the key here is that these have to be temporary. These cannot be permanent. If they're permanent, they're going to impact trend output. So these are the kind of things that don't impact trend. They don't impact trend. They're just temporary. They're 1 year, 2 year things, like COVID, right? Let's hope that COVID doesn't permanently impact the trend level of output in the US, but it has temporarily led to some pretty big changes in the cost structure for firms and businesses. So how would we deal with this graphically? Well, let's look at an example of a negative supply shock. How would we draw that graphically? Well, in this case, if we start out at our long run point of 0, 0, what happens if O bar is positive? This actually shifts our Phillips curve up in this direction. And notice that if short run output doesn't change, that inflation would go up by O bar. You might be asking yourself, why in the world would your book pick O bar when O looks like 0? Excellent question. I've actually communicated this to the author a few times. I don't know why he likes using O bar. I don't like using O bar. I'd prefer to use some other variable, but we'll use O bar because he's using O bar. So there's no source of confusion. But the key here is that's not a 0. That's an O, right? O bar. So here, the negative supply shock directly leads to a change in inflation. Okay, so we've added 2 really important pieces to our short run model here. We've added the MP curve that thinks about monetary policy, and then we've added the Phillips curve, which helps us think about how short run output relates to changes in inflation. So at this point, we really kind of have, I would say, like the backbone of our short run model, right? We have the backbone together. And so what I want to do, we're going to take a break here. Let's take about a 5-minute break. But after break, I want to kind of talk about, first off, using this model, right? So let's use this model to maybe explain a couple of examples in US economic history, right? Use this model to kind of think about how we could explain past recessions in the US. Use this model to think about how exactly we can think about stabilization policy, okay? So we will, come back after break and we'll kind of talk about how to use this model, right? So we've done a lot of the heavy lifting here already this morning. So this afternoon, we'll just make sure that we hopefully understand what we've learned already. Okay, so as I said, let's take 5 minutes or so and we'll come on back and talk some more. Hey, everyone. All right, so you know what we haven't done for a while? We have not done which would you choose. It's been a busy day, a busy week. So let's do which would you choose just for 5 minutes, just as something to do. It's it's a very small, fun thing to do, but it feels like it's Friday, and we should do at least some one thing different from just drilling through tedious macroeconomic models. So, all right, I'm picking out a card at random. Let's hope it's a good one. Okay, well, this is the weird one. So, which would you choose? Friendly aliens offer to show you the galaxy, but you can never come back to Earth. Or aliens abduct you for a week of medical experiments, but then you can go back to your regular life. Okay. So, once again, friendly aliens offer to show you the galaxy, but you can never come back. Or the aliens are going to abduct you only for a week, but they're going to perform medical experiments on you. We know what kind of medical experiments those are going to be, right? And then you can go back to your regular life. Okay, so I'm going to put you, how many do we have here? I'm going to put you in 3 breakout rooms. So we'll do this for about 4 or 5 minutes, and then you guys can come back and report to me the intelligent, insightful things that you've learned. only your group is coming back. All right, here comes everybody at large. Okay, I think most everybody's back here. Okay, who voted to never come back to Earth but explore the galaxy? All right, you guys are the adventurous spirits. Logan, why would you never come back to Earth? Do you hate us here?
So my theory is, so if we're exploring the universe with some aliens, right? They got that technology. They can travel the speed of light or faster than the speed of light. And then if that's the case, you know, like the theory is that if you travel faster than the speed of light, you can travel through time.
Mm-hmm.
So I would come back at a time when Earthlings have, not Earthlings, but people have colonized like Mars or something, and I'd go live on them with the next planet,
Mm-hmm.
back with my people after exploring the universe.
Mm-hmm.
So,
okay, all right, I like that. Of course, there's also the theory that you can't actually go faster than the speed of light.
or yeah, they know something we don't. I hope we'll
Right.
figure it out.
Oh, well, we'll miss you, Logan. It was good to have you with us.
I'll come back to the macro theory of the universe.
Exactly. You go to the future when we figured everything out macro, and then you'll come back and you'll tell us all the things that we learned that were wrong. I like it. All right. Who said they would come back after they've been probed for a while? Only Cole? Cole, you just you can't be done with Earth?
No, it wasn't that. I was just thinking, well, yeah, but we were talking about in our group, like the hypotheticals, like who knows if you'd even understand them the entire time. And I like interactions with people. Don't get me wrong, I like the adventure, but with medical procedures, I went a little beyond the probing idea. I was like, as long as I'm passed out, it's pretty much a colonoscopy, so that happens every day to people. But I was like, you never know. There could be a chance of like superpowers in there or something like that. You don't know what medical experiments or whatnot they're doing to you.
Okay, all right. I like it. You're thinking creatively. You're. I can tell you're an optimist, right? Somehow you think that getting probed is going to give you superpowers. So I can appreciate that.
Sometimes you got to be in that case, I guess.
Right. In 2020, we all need a reason for optimism, right? So yeah, I get that. I get that. So yeah, I don't know what I would pick. I'm sure the galaxy would be fascinating, but there's a lot of fascinating things to do here on Earth if you can actually travel. So that's a tough one. I think I would probably stay around. Yeah, I think I would probably stay around. As you said it, not that you guys want too much information, but I've actually had a colonoscopy and I slept through the whole thing and it was just fine. So I agree with you, Cole. As long as I'm knocked out, then what happens on the space station stays in the space station. So okay, so back to the more mundane. Let's talk about using our short run macro model, right? And so part of this is kind of understanding a little bit more about the history of business cycles in the US a little bit more. But then part of this is also getting more comfortable with understanding our model and making sure that we understand some of the mechanics of our model and what our model can help us understand, and then maybe some of the things that our model can't quite help us understand that we need to kind of improve as we move along. So using our short run macro model. Let's first begin talking about, actually I'm going to change. Let's first begin talking about, I was going to change on the fly here, but let's talk about the inflation buildup of the 1970s. and see if our model can help us understand why inflation got so high in the 1970s. And then how did we recover from it? How did we push inflation back down in the 1980s? So just to show you, just to remind you how bad things got, so this is figure 12.9 from your book, where you can see inflation in the US since 1960. So you see that there was this kind of dramatic buildup of inflation starting in the late 1960s, but then really taking off in the 1970s. And then beginning in 1980, we had this dramatic reversal where basically inflation dropped quite dramatically from 1980 to 1982. And then since 1982, we've had kind of a slower reduction in the level of inflation, but much, much more moderate. So in US history, we haven't really had a period like this ever before and since, where inflation spiked so dramatically and then spiked down so dramatically. And so let's see if we can use our short run macro model to help us understand what's going on here. There's three factors that played a role in this, okay? One factor is we definitely had a supply shock. And that supply shock was essentially in the oil market. So the 70s were an extremely volatile period of time in the US oil market. Basically, oil prices doubled at 3 different points during the decade. They doubled in 1972 with the Israeli-Egypt war. They doubled in 74 with the OPEC oil embargo, when OPEC nations put an oil embargo in the United States. And they doubled in 1979 with the Iranian Revolution. And it's important to note here that the US economy at this time was much, much more oil intensive than it is today. We were much more directly related or directly dependent upon oil. First, because, basically conservation and energy efficiency was not a technology that had been much invested in, coupled with the fact that there were very few substitutes, right? Natural gas was a much harder to access substitute. We certainly had no renewables or very few renewables like water or solar. And so we had a much, much more oil intensive economy. Our economy was much, much more vulnerable to these things. However, there was a couple of other factors that played a role in this. One was a policy mistake. And that policy mistake was the Fed thought that the fall in output was driven by a fall in A bar, not a rise in O bar. In other words, they thought it was a demand shock instead of supply shock. And as a result, the Fed responded as if it was a demand shock by cutting interest rates. So let's talk about these last 2 points first. The Fed thought that this is what was happening. Fed thought that the IS curve is going down and short run output had fallen and we were in a recession. So what did the Fed do? They cut interest rates, thinking they were driving short run output up to zero. Right? So they were thinking the short run output would go back to zero as they cut interest rates. But what was really happening? Instead, the IS curve hadn't shifted at all because A hadn't changed. It was O. And so when the Fed cut interest rates, what were they really doing? They actually drove short run output above zero. The problem with this was when we look to our Phillips curve, what was the Fed then doing to inflation? The Fed was driving up, by driving up short run output, they were driving up inflation. Okay, but I need to be clear here. That wasn't the only thing that was driving up inflation. Actually, let me erase this a little bit. I should kind of do this out of order. The first thing that was driving up inflation was the supply shock. Sorry about this. Got to adjust my graph. So first the supply shock drove up inflation, and then, right, once inflation was driven up by the supply shock, it was then also driven up again by the Fed. Okay, does that make sense? So first inflation gets driven up by the supply shock, O bar, and then inflation gets driven up by the fact that the Fed is cutting interest rates. And worse than this, the Fed made the same mistake in 72, 74, and 79. They basically kept on making the same mistake. So what the Fed kept on doing, I won't draw it in this graph because it's going to get too complicated, but imagine this happening again and again and again. It led to a huge change in inflation, right? When coupled with the 3 increases in the supply shock. And that's essentially how we got this runaway inflation. It was a supply shock that was then aggravated by a Fed mistake in policy. The Fed thought that it was a demand shock. They did not really anticipate the possibility that it was a supply shock. And you might say, how is that? And the answer is, the Fed really had a very narrow model in mind. They essentially had this short run model that we're talking about in mind, but they had never incorporated the possibility of a supply shock. So they didn't have O-bar in their model, in their mental models, in their empirical models. And so when, in part because something like this had never happened before, right? Economists, basically any sort of policymaker, anybody, any person, is vulnerable to what we call the black swan phenomenon, right? And the black swan phenomenon refers back to when people from England first went to Australia, and they came back and they told their friends and neighbors, hey, you know what they got down in Australia? They got black swans. And everybody said, you're full of it. No way. Everybody knows that swans are white, right? And it's hard to believe things that you've never actually seen before. And that's kind of what's happening here, right? Is that the Fed really never thought about the possibility that recessions could be driven by supply considerations, because they were very focused on demand considerations. They were very focused on shifts in the IS curve, and it never really thought about, you know, these kind of big supply shocks that could shift the Phillips curve. So in essence, the Fed made there were some economic shocks that drove up inflation that were out of the Fed's control, but in many ways the Fed then aggravated these shocks and really drove up inflation. And so by 1980, we had roughly 14% inflation. So this was a situation that was untenable. We know what the costs of inflation are. We talked about them on Tuesday. This led to a lot of redistribution of wealth, created a lot of winners, a lot of losers. It undermined finance. The financial system was rocky. Wages were having a hard time keeping up with inflation. And so people saw their real incomes go down. Ronald Reagan, who became president in 1980, essentially in many ways ran against the Federal Reserve, saying the Federal Reserve is incompetent. The Carter administration was enabling these incompetents. You got to let me become president. I'll take care of things. So when he became president, basically Reagan said to the chairman of the Federal Reserve that he would give him political cover if the Fed should do what they need to do to cut inflation. And that's exactly what people in the Fed wanted to do, right? The people in the Fed wanted to kind of correct the mistakes that they made in the 1970s. And so let's talk about that. What happened during this disinflation in the 1980s? And basically, I think it was actually 1981. The Fed decided to dramatically raise interest rates. And by some measures, when I say dramatically, some real interest rates went to over 20%. Okay, that's huge, right? A extremely sharp drop in interest rates. Or, I'm sorry, extremely sharp increase in interest rates. Okay. So here's where we were in 1980. Notice that short run output is positive, right? Short run output is positive, and inflation is very high. What did the Fed do? They dramatically raised interest rates and dramatically shifted this MP curve. And so we went from a period where short run output was probably positive to a period where short run output became immediately strongly negative. And you can imagine the consequences, right? A very, very severe and sharp recession. Unemployment immediately shot up to above 10% as the economy dramatically slowed down. But what happened to inflation? This is where we were in 1980. And where does the Fed move us in 1981? All the way down here. And they start squeezing the inflation out of the system. By raising interest rates that dramatically, they essentially squeezed inflation out of the system. And so the result was at that time we had the sharpest recession since the Great Depression. But inflation fell from 14% in early 81 to about 6% in early 82, right? So the Fed dramatically slammed on the brakes. Dramatically slammed on the brakes. And I'll explain this a little bit more, but one thing that happened was public caught on to what was happening. And they began to reduce their expected inflation rate. And the prices in the economy adjusted, and short run output went back to zero, right? So in other words, that recession ended as the public kind of readjusted all of their prices, readjusted their expected inflation rate, and moved us back towards zero. Okay? So that's kind of a long, complicated history of the 1970s and early 1980s in the US. But, I think one of the interesting things about going through this is it shows you the power of our short run macro model, right? Our short run macro model is really kind of capturing, it allows us to think through many of the events that happened during this very complicated period, right? And so it gives us better insight into what's going on. Let's talk about another example. This is a much simpler example, an example that's, I think, much easier to kind of to think about, and that was the 2001 recession. And the 2001 recession was what we could think of as a typical aggregate demand recession, where A bar fell below zero. The 2001 recession is often referred to as the dot-com recession. You all were just little babies, right? Yeah. No, wait. You weren't even born. Shit. God damn it. I hate these kind of realizations. Most of you, some of you might have just been born. Some of you probably have not been born yet. But the 2001 was a very typical aggregate demand-driven recession, often known as the dot-com recession. So what had happened in the late 1990s is that the internet was just taking off, and a lot of these dot-com businesses had really exploded. And a lot of these were dot-coms such as pets.com that basically had, at the time, I think like a $300 million initial public offering for an online company that sold pet food. Okay. And so some of these initial offerings completely exploded in a classic stock market bubble, only to literally explode in 2001, when I think many people got realistic that a lot of these dot-coms really had no real business model. And so what happened was that the NASDAQ, which is a stock market index that's very tech intensive, fell by about 50%. And it was a big decline in wealth. And this decline in wealth almost certainly reduced people's consumption. It caused firms to get much more cautious in terms of their investment. And we had a typical demand-driven recession. So if we look here at our ISMP curve, what happens? IS falls as A bar goes down. And output fell quite dramatically. However, in reality, output did not fall this dramatically because there was very aggressive stabilization policy. The Fed used monetary policy to cut interest rates to try to stimulate the economy. But the other thing that happened was fiscal policy, where there were a series of tax cuts and an increase in government spending to try to, for instance, spending on unemployment, extending unemployment benefits. And both of these things increased government spending. They probably also served to increase consumption. And so at the risk of making our previous graph too complicated, what happened was that fiscal policy shifted the IS curve back, and the IS curve shifted partly the way back because of fiscal policy, and then also the MP curve shifted. And so the recession did not last very long, and it was not a very severe recession, in part because stabilization policy took place in a fairly prompt and effective way. So unlike the previous example that we talked about, where the Fed and government policymakers kind of muck things up, this is an example, kind of the textbook example of how you should run monetary policy and fiscal policy, right? I mean, the fiscal and monetary policy responses to this have been pretty textbook. I hate to get into the COVID discussion too much here, because I think there's a lot to say. And then also we're kind of right in the middle of things. So, you know, we don't know what exactly is going on in some ways, because, you know, we're kind of right in the middle of very important events. But I have to say that, you know, if you want to think about the recession that we're currently in, it probably began very much like a recession, a demand-driven recession, like this one in 2001, where a bar fell as people stopped spending, firms stopped investing, as they began to really worry about what were going to be the consequences of COVID. And people stopped traveling, people stopped going out, people hunkered down. You know, I think a lot of what's happened during the 2001 recession, you can think about as a demand-driven recession. Now, there might also be some supply shock aspects to this as well. But, you know, let's kind of just focus on the demand-driven recession. What was the federal government's initial response to this? I think most economists thought that the government's initial response to this was actually pretty strong. Fed aggressively cut interest rates and aggressively moved to try to stabilize the financial system. Fiscal policy was actually also probably pretty strong. The federal government passed a tax, or a roughly, what was it, about $1 trillion stimulus package, in which people were given money, right? Those stimulus checks. There were bailouts or loans extended to small businesses to encourage them to keep people in their jobs. And so all of these things help to stabilize the IS curve and prevent short-run output from being too negative. So in general, I would say that at the beginning of this crisis, the government's response was pretty effective. Now, where are we today? Today, I'm not nearly so sure that that's the case, right? If you've been reading in the newspapers, I think everybody agrees that there needs to be a second stimulus package, right? As we move towards the second year of this, and almost certainly this is going to extend into 2021. I think almost all economists that I am familiar with think that we should have a second stimulus package. And this stimulus package should include things like extending unemployment benefits, providing loans and more support to small businesses, maybe having another stimulus check, right? But I think that's probably a little bit lower down. I think, you know, most reasonable economists think that there needs to be some targeted support to those individuals and businesses who are suffering the most. But yet, if you're reading the newspaper, what you find is that Congress is so dysfunctional that all they can do is argue about this. And they've been essentially arguing for 3 months about this second stimulus package. And yet it's not clear what's going to happen, if we're going to get it. And so, you know, I think here's a situation where politics, in many ways, is preventing good policy in which, in general, I think economists could agree about 90% of what should be in this. And yet our politicians cannot get their acts together to pass this. And so, you know, we'll have to see what happens, right? And I think really, to me, a big question about how bad this recession is and how long it lasts. Part of it is related to to how long COVID itself lasts and whether this vaccine works. But in part, it also responds to, can we do the textbook things that we should be doing, right? In other words, do our policymakers, the economics of this is pretty straightforward. The politics is what's screwed up. I guess that's what I'm trying to say in a nutshell, right? I mean, I think, you know, most reasonable people agree on the general kind of things that we should be doing, yet our politics are so in such a mess that we can't even do the, you know, generally accepted things. And so, you know, as this stretches on, and if something doesn't get done, we're going to see more people lose their unemployment benefits, run out of unemployment benefits as they get past that 6 months. We're going to see more people defaulting on their houses, more people defaulting on their student loans. We're going to see more small businesses go out of business and more people lose their jobs. And, even if things are going to be better in 3 months, 3 months is a long period of time. And there could be some more permanent damage incurred if the government doesn't get in here and try to help a little bit more with stabilization policy. So anyway, that's an aside. Just kind of think about, some of the current events that are happening today. So the short run macro model, I think, helps us think about that a lot. All right, we probably have, I would say, to finish up chapter 12, we have maybe about a half an hour or 40 minutes worth of material. And so I think I would just prefer to save that for this afternoon. Hate to bring you back on a Friday afternoon, but I promise we'll make it quick, okay? So this afternoon, just a couple of things that we'll talk through. Also, we'll save a little bit of time if you want to talk about homework number 3 and have any questions about that for the weekend, okay? So in the meantime, have a good break, and we'll see you back here at 12:30 for a pretty short afternoon session, hopefully. Okay, bye-bye.
You're recording yesterday's morning that we missed today, right?
I think yesterday's morning.
You missed like the first.
Yesterday afternoon. I think what I will do is I'm going to send out just some notes from that first part. So I don't think I'm going to re-record it. I'll send out some notes, and I'll send that out in the email.
Okay.
Okay? Shinyi, how are you?
Hi.
Good. Hey, Kai, are you still here? I tell you what, I'm going to, Shinyi, I'm going to end our meeting, and then I'm going to
Okay.
come back in, and you stay here, okay?
Okay.